Hello, everybody. This is Mike Moyer, author of Slicing Pie. I'm thrilled to have you join me for this Slicing Pie 101 webinar. This is new software I'm using today. I'm not sure it's working properly. Please text in if you can hear me and see a picture of a mouse sitting on a swing set. Awesome. Looks like you can see me. So I've had some troubles in tests. Looks like a lot of people logged on. I hope you didn't get blocked out. If you're on, you're on. If you're not, you got blocked out. I apologize. So we'll go ahead and get started here. Thanks again for joining me. I appreciate it. Looks like people from all over the world, Dubai and Texas, and lots of people signed on. Great. So happy to see the interest in slicing pie. This is one of my favorite topics in the world. Today I'm going to go through the slicing pie model and teach you how to get exactly what you deserve from your company, no more and no less. The slicing pie model is what I believe the solution to all your equity problems. If you want to contact me after this, you feel free to chat in the chat box. I'll get to your questions as I can. And there's my Twitter if you want to Twitter. And, of course, if you want to get the slides, slicingpie.com/feedback. You can get a copy of similar slides, not these exact slides. I change my slides all the time. So what I'm going to talk today about is slicing pie. And I believe that slicing pie is a universal, one-size-fits-all solution for the allocation and recovery of equity in an early-stage bootstrap startup. So that's what I'm going to be talking about today. It's very rare that you hear someone say universal one size fits all. People always say, oh, it depends on this, it depends on that, it depends on what you want to do. But I believe that this is a one size fits all solution for a bootstrapped startup company. So hopefully this is a starting place for you to get your head around how this works. If you don't think it fits your particular needs, let me know, and I'll help you walk through this a little bit. This webinar will last about 45 minutes to an hour. Slicing Pie is used all over the world. It's a program that's been becoming very well established over the past few years. It's grown. It's been translated into a number of languages. So I hope that if you're considering Slicing Pie, that you'll take comfort in the fact that it is definitely used all over the world by entrepreneurs everywhere. And I'll be happy to share with you more details about that if you're interested. The question I always ask startup companies is, why do they start companies? What's the purpose of starting a company? And I usually get three answers. They want to work hard along the way because startups are very, very hard, but it's fun. Startups are a fun thing to do. Startup companies are fun. If you've ever worked for a real company, a big established company, you know that it's a grind. People don't treat you the way they should be. They don't value your opinions. They don't pay you well enough. So we want to work for a company. Someone's asking to make the slides bigger. Hopefully that helped make the slides a little bit bigger. I'm testing new software today, and I'm not quite sure how it's coming across on the other side. But so anyway, a startup company is about hard work, having fun along the way, and then getting a big payout somewhere down the road. The problem is we have no idea what our payout's going to be. No one can tell what the payout's going to be. No one can predict what the payout's going to be, yet we try all the time. We try to do financial modeling. We try to do projections and comparables and try to figure out how much we're going to be worth someday. And it's a major problem. Someone can't see the slides, unfortunately. Can you see the slides now? Now can you see the slides? That's really confusing. Now can you see the slides? Are they small now? This is good. All right, looks like the slides are disappearing. I'm sorry, folks. We're having some technical difficulties. No slides now. Fine for some folks, not fine for others. It's okay now. All right, I'm going to keep going. And after this, I'll have a talk with my webinar service provider. So I apologize for this. So we're going to have fun along the way. So there's 3 success criteria. The first success criteria for most startup companies is to change the world. They want to make a positive impact to the world. The second criteria is they want to make lots and lots and lots of money. And the third criteria is to get their fair share. And this is what we're talking about today, is they're getting your fair share of what you deserve. Because if it's fair, it'll be fun. Startups are fun as long as things are fair. And if they're not fair, they won't be fun, and people feel this all the time. There's an old saying that success is like being pregnant. Everyone says congratulations, but no one ever asks how many times you're screwed to get there. So sorry if that sounds too crass, but it's really, the truth is it's very hard to get to success. And as long as it's fun, we'll keep trying, keep trying, keep trying. So the perfectly fair equity calculation that I think most people are going to agree to is that your share, your ownership should be the value of your contribution divided by the total value of the firm. This means your value that you contributed divided by the total value should be your share of the company. The problem, of course, is we can't predict total value and we can't predict your value of the firm. So most people do, because this is such a challenging problem, is they do what's called a fixed equity split. And a fixed equity split is a situation that's usually done at the outset of the venture. Most companies do this at the outset of the venture, where they try to determine in advance how much the company is going to be worth and how much each person's participation is going to be worth and how much time they're going to spend. All of these things they try to predict in advance in hopes of getting it right. And this is an extremely difficult problem. In most cases, they look for something that they do an equal split. An equal split is basically a punt on this thing. Hey, we're good friends. Let's go 50-50. We're three guys, three founders. Let's go a third, a third, a third. Most people do an equal split. And this is because the problem is so complicated. And this is sort of feels right in the beginning. But as I'll explain later, it's actually not right. And we'll see how it runs into some problems. Sometimes someone will say, well, this was my idea, so I want a premium. I want more equity than the other person. So they'll do 60-40 split or a 51-49 split, for instance, or 25-30-45, some other kind of split in hopes of getting it right. And people scratch their heads about this, and they wonder if they're getting it right or not, and they're always getting it wrong. A fixed split is always wrong. And no matter how careful you are, it's always going to wind up into problems, because whatever you started with, whatever thoughtfulness you started with, things are going to change along the way. You know, what if you do all the work, we're 50-50 and I have half your company, but you're doing all the work? Then what do you do? Or you want to bring in a third person. Whose equity does it come on? Does it come on my equity or does it come on your equity? What if your partner wants to quit? Does he get to walk away with half your equity? What if you want to quit? Do you get to walk away and keep half your equity or whatever it is? What if your CTO gets hit by a bus? I actually saw a situation once where the CTO got hit by a bus and was subsequently died of that accident, and his wife inherited half his equity, which was the right thing to do, but she could not add any value in terms of CTO or technical skills. So the existing founder had to give her half the profits. The company had a long way to go. There's millions of things that can happen with your company. The only thing that doesn't change in a company is the fact that they always change. So we need to accommodate for these changes and understand going into it that whatever we think is going to happen is not actually going to happen. So we have to make a program that will allow this to change over time. So when things change, one of these things is going to be true. The first one is you have this less than alligator over here. It's the greater than, I mean. Your share will be greater than your contribution. So you have more than your fair share. And some people are okay having more than their fair share. But most people recognize that having more than your fair share means, by definition, that somebody else has less share, less than they deserve at their expense. You have more at their expense, which is not fair. The other situation is when you have less than your fair share. No one's comfortable with this. In fact, when you start getting less than your fair share, you start being less motivated to work and not contributing, and you eventually give up and quit, and it leads to a lot of fights. And this is a very common scenario. So I call these alligator pit negotiations. When you go into a negotiation about equity splits, you know you're going to come out with either less than you deserve or more than you deserve. And this is a very uncomfortable, stressful situation to be in. We want to do everything we can do to avoid the situation, because you want to get out of there. You're fighting with your partners. It's gnashing teeth and swinging tails, and it's not a good situation. You want to be working with partners that you know have your best interests in mind, and vice versa. Because if it's not fair, it will not be fun. So when I developed slicingpie, I went down, I sat down and I wrote some criteria first. I said, what does this need to do in order to be fair for everybody involved? So first criteria is I wanted something to be perfectly fair. I didn't want to be kind of fair or sort of fair. I wanted a program that is perfectly fair. I wanted to reward actual contributions made to the firm. I didn't want to predict what someone's going to do. I wanted to wait till they actually did it and then give them a reward for it. I wanted to provide ongoing motivation. As soon as people get a fixed split, their motivations change. I wanted to accommodate team changes, knowing people are going to leave and come over time. We're going to add people are going to quit over time. I want to be flexible in the face of rapid change. I don't want us to redraft all my agreements every single time something changes. And I want to get rid of the gators. I don't want anyone to ever think that I'm not treating them perfectly fairly. So these are the criteria for slicing pie, and that's what I'm going to cover today. So hopefully by the end of this, I'll convince you that these criteria are met. The solution to this problem is called a dynamic equity split. And a dynamic equity split is one that changes over time to make sure it stays fair. And there's research that's shown that fixed splits cause problems, and a dynamic split is a potential solution for this. And today I'm going to show you a practical solution for implementing a dynamic equity split. So if you contributed 50% of what it took to get there to success, you should get 50% of the rewards. If you contributed 10%, you should get 10% of the rewards. You should always get exactly what you deserve, no more and no less, no matter what changes. So the basic premise is this. The basic principle behind slicing pie is this. A person's percent share of the rewards should always equal that person's percent share of the risk taken to achieve those rewards. So rewards in a startup company are the profits generated or the proceeds from a sale. If you're seeing the slide small on your screen, you might try refreshing your screen. That might help. There's a reconnect button at the bottom of the screen. So here's what I mean by this. Let's say you and I go to Las Vegas to play blackjack. We're good friends. We have an idea to play blackjack. We're going to split the winnings 50-50 because we're buddies. We each bet $1 on the same hand of blackjack. If we win, we should split the winnings 50-50 because we agreed to and because we bet exactly the same amount of money. So the dealer deals an ace and another ace. So we have two aces. Now we have a choice. We can split these aces and double down our money and play another hand and potentially get more money out of this bet. So we ask the dealer to split the aces and double down. But I'm out of money, but you're not. So you put $2 more down, and I only have my $1. So now you've bet $3, and I've only bet $1. So in this scenario, even though we went into it with a 50-50 split in mind, it doesn't make sense anymore because you bet 3 times as much as I have. It would be logical that you would get 75% and I would get 25%. Startups are exactly the same thing. They are a gamble on the future. And before break even, we're betting on the table, betting on the startup. We're contributing time and ideas and money and relationships and all kinds of things. After break even, we're generating profits. We have no idea what our profits are going to be. We have no idea when they're going to come in. We have no idea how quickly they're going to come in, or how much they're going to come in. We don't know we have no idea. It's an impossibility to know. What we do know at break even, however, is we know exactly what bets are on the table. We know exactly what was spent. We know exactly how much time was contributed. We know everything about our company before break even is an absolute knowable thing. So when you're going to a startup company and you're placing bets, you're betting on the future of a startup, and the value of your bet is equal to the fair market value of the contribution you made. So what slicing pie does is it tallies up the bets and it divides up equity based on the fair market value of the contributions made. So that's how it basically works. The fair market value is the amount of money that you would pay on the open market for any contribution. So if I could be hired for $100,000 a year doing marketing, and I do marketing for your company, I'm betting a $100,000 salary. The fair market value of my cash consumed is the value of the cash. The fair market value, everything has a fair market value. Imagine you had a magical ATM machine, and it would spit out money to pay for your expenses as long as you made good choices. Those good choices you made would generally be the fair market value. So instead of trying to project how much things are going to be worth in the future, we can think about how much are they worth today on the fair market. So when you contribute to a startup company, you're betting the fair market value of your contribution on the future outcome of the startup company. So the slicing pie model is called a grunt fund, and there's two pieces for it. The first piece is the allocation framework, which teaches us how to allocate shares in our startup company. The second piece is the recovery framework. When somebody leaves the company, we need a methodology for getting the shares back, if appropriate, from the person that's leaving. We need a buyout price. So here's how it works. The first thing you do is convert all contributions to slices. A slice is a fictional unit of at-risk contribution. It's your bet. Think of it like a poker chip, for instance. It's just a fictional unit to measure your bet. And at any given time, no matter what changes, your share is always equal to your slices divided by all the slices in the pie. And it will self-adjust over time to keep it fair. Because each day that goes by, we spend more money and more time and more ideas on our company. And we want to make it self-adjust so it stays fair. That's why it's called dynamic. There are two kinds of contributions people can make. There are non-cash contributions like time and ideas and facilities and supplies and relationships. And there are cash contributions, which are cash investments or unreimbursed expenses. Any consumed cash is a cash expense, the cash contribution. You simply take the fair market value of whatever it is. And indeed, most of my books about slicing pie, most of the books are about how to determine fair market value. And you apply a multiplier. The multipliers normalize the contributions and standardize the slices, and they also impose consequences at the back end of the system during the recovery framework. So I put a multiplier of 2 on non-cash contributions and 4 on cash contributions. And that's because cash is more scarce than non-cash. We usually have more time than we have money. Cash is calculated after taxes too. So if you wanted to buy a $100 thing and I paid you $100 an hour, at the end of the first hour, you would not be able to afford to buy that thing. Because when I paid you, I would have to deduct my employment taxes and the Social Security taxes. And then when you receive the money, you have to pay income taxes. And when you bought the thing, you had to pay sales tax or VAT tax. So you may actually have to work 2 hours in order to buy that $100 thing, even though you get paid $100 an hour. So we give cash a premium. And so to account for the scarcity of cash, the difficulty in saving cash, and the taxes, I do twice as much as I do for non-cash. So here's how it works. For someone's time, you take their fair market salary. Let's pretend someone could make $100,000 a year. And you minus cash compensation, because if you're paying them, they're not placing that bet. So if I paid them $100,000 a year, they're taking no risk and they deserve no equity. If I pay them $50,000 a year, they're making a $50,000 bet. If I pay them nothing per year, they're betting $100,000. So I multiply by 2, which is my non-cash multiplier, and I divide by 2,000, which is the number of hours in a year. That gives us our grunt hourly resource rate, or GRR, which is the sound you make when you're working hard in your startup company. So $100,000 a year salary, if I paid the person $25,000, that would mean $75,000 of his salary is at risk. Multiply by 2, divide by 2,000. That gives us a grunt hourly resource rate of 75 slices per hour. So every hour that goes by that this person invests in the company, he is contributing 75 slices to the pie. He's betting 75 slices. It's important to use an hourly rate because people have different commitment levels. Some people work full-time. Some people work more than full-time. Some people work part-time. Some advisors might only work a couple hours a month. So the hourly rate allows you to break your time into units that make sense and allow you to measure different levels of commitment. Yes, you have to measure your time, but it's not as big a deal as most people think. Small amounts of money. You simply multiply the cash amount times 4 when it's spent. Cash in the bank is not at risk. So if I invested $1,000 in your startup company, I get no equity because it's not at risk. When you spend my money on rent or salaries or whatever else, then it becomes at risk and it converts at a rate of 4 slices per dollar, or whatever unit of currency you're using. So it's important to know that no matter how much money I invest in a company, it's just sitting in the bank, so it's not at risk. When I spend the money, it becomes at risk. Equipment, if I bought the equipment new for the company, it's the same as cash. It's consumed cash, the unreimbursed expense, so I multiply by 4. If it's less than a year old, I usually use the purchase price. It's a non-cash contribution because I already owned it because I didn't spend cash on behalf of the company, but I multiply by 2. If it's older than a year, I use the book value or look on eBay, and I treat it as a non-cash contribution. Everything has a non-cash, has a fair market value. So relationships are usually very important. In the real world, when a relationship gets rewarded, it's usually in the form of a commission. So if I don't pay you a commission, it's a non-cash contribution. I multiply by 2 for slices. In the real world, if I'm an idea person and I can license my ideas to companies, I'll get paid a royalty. If I don't pay the royalty, that's at risk money and it's non-cash, I multiply by 2. If I buy equipment and supplies for the company, it's cash consumed, so it's times 4. Everything has a fair market value and therefore can be converted into slices. So let me show you how this works in practice. So here are some grunts milling around the local incubator looking for some work. I'm going to pick 3 of them and start a company. Here they are. Junior developer, she's right out of college. She's a web developer, does app development and WordPress stuff. The founder is an experienced founder who's going to put the idea in and some time and some equipment. And the rich uncle is going to bankroll this thing and bring some important relationships to the table. So the first step is to convert all their stuff to slices. It's a piece of cake, knowing this, all you do is multiply non-cash by 2 and cash by 4. So boom, there they are, the slices have been converted. Now we add up all the slices in the pie on a rolling basis. Then you divide each person's share by the number of slices they have. So this is grunt number 1 share, number 2 share, and number 3 share. So at this point in time, the uncle has 60% of this pie, and the junior developer has 7%, which makes sense because she just put some time in and it's not that important, where the uncle bankrolled this thing and spent more money. The founder, who did not spend as much money but did put some time in, has less share, but the rich uncle is the person who really bankrolled this thing. So at this point in time, the pie is exactly as it should be. Now let's add somebody else. This is a sales guy. His name is Bob. He's got a long Rolodex, has been in the industry for years. He's very valuable, but he's going to put some time in at a base rate. He's a commissioned salesperson, so he's going to bring relationships to the table. We're going to convert his stuff to slices. There you go, convert it to slices. All we do is add his slices to the rest of the pie. Now we're going to pretend for a second, for example purposes, that we're not adding any more. No one else is doing any work this period, but in practice they would. But all you do is add this person's slices to the pie. There they are. And you recalculate everyone's share. So here's number 1, 2, 3, and our new guy 4. So now the pie looks like this. The salesperson who came in and made some important sales. The junior developer has 6%. She has a little bit less, which is fine because now the company's bigger. There's a question coming in, why does the founder who came up with the idea, did all the research, et cetera, get more of the pie? I think the question is, why didn't they get more of the pie? They did get more of the pie. Their ideas were wrapped up into that. If I hire you to work for me, I expect you to do research. I expect you to generate great ideas and all kinds of things. And if you're getting paid for that, that's part of the pie. If you develop that before the pie, then you might have a situation where you can license that stuff to the company. But the founders should only get what they deserve. I got another question here. The fair market salary value of a person's effort and time changes over time. How does the slicing pie model take into account changes over time? Well, typically, if you have a real job, if you're working in a corporate environment and getting paid a salary, your salary does not change day by day. Your salary changes based on your performance. So you usually get your salary every month. You get paid a check, and during that time you work for the company, your job is to come up with awesome ideas and create rain. If you're doing a great job coming up with your ideas and a great job executing, you usually get raises. If you do a lousy job at your job, you usually get fired. So Slicing Pie works like a real company. It simply takes into account what people are doing and what the fair market rate for that work is. And if they don't pay them, they use slices. If they do pay them, they can just use cash. And eventually you will want to pay people. So always think of your company as a startup company, as a regular company that has salaries being paid. For some reason, people think that magic happens in an entrepreneur's mind. But the magic is happening all over the world. But usually people get paid for it. If I work as vice president of marketing for a motorhome company, it's my job to invent new motorhome products, and my job to think of great marketing ideas and do all kinds of cool stuff, and I get paid a salary for doing that. There's another question about the end of the year for taxes. Slicing Pie has got nothing to do with value of your company. We're doing this. This is a pre-break-even or pre-break-even model. When your company has a priced round, your equity will convert, and there are some tax strategies you can use to reduce your taxes, but not, of course, to not eliminate your taxes. But you would get a K1 or an LLC based on how the pie divided at the end of the year, for instance. But usually during this period, the company has no real value. So another question: the participation of the partner is equal to the dedication, right? If you contribute less, his percentage is smaller. But let's say after 1 year, appears the opportunity to sell or start up in 2 months, he decides to contribute more. his participation will increase. Is that fair that a partnership who actively contribute for 2 months deserves greater participation? Yes. So that the partner contributed an hour a month for a year, and then before the company sells, they show up and start working 40 hours a week. Well, that's okay as long as the company needs that. You can't just work for not contribute anything. The company has to need your participation. So it always reflects the amount of effort that's put in. And of course, as a management team, you decide how much work you need. If I only need you part-time, then you working full-time is not necessary. If I need you full-time, you come on and work full-time, that's great. So it'll absolutely reflect the level of work you do, which is one of the nice things about this, is people's commitment levels can change over time. Someone may be working full-time on it first, then have to go get a real job and only be able to work part-time in the evening. So people's commitment levels change. But they'll always be exactly accounted for in the model. The recovery framework deals with how people leave a company if and when they decide to leave. There are 4 reasons why someone can get fired or leave a company. They can be fired for good reason, which is box A. Being fired for good reason means they weren't doing their job, and they got 2 warnings, or they were gross negligence, they stole from the company, embezzlement or sexual harassment or bringing a gun to work, things like that. These are fairly well documented reasons. But performance-related should always receive 2 warnings. You give someone warning, you're fired. If you want to fire someone for a good reason, for performance-related, you have to give them an opportunity to correct their behavior, otherwise it's not fair. Firing someone for no good reason means you fire them for whatever reason you want to without warning. Maybe you don't like looking at them during the day, you don't like the way they talk, you don't need them anymore, whatever that happens to be. You can fire someone for any reason you want to. Most countries have at-will employment. But unless you give them warnings and they didn't breach a contract, then it's called fired for no good reason. You can also resign for good reason. Resigning for good reason means the company's situation's changed in a way so it's not what you signed up for. So if you joined the company as the vice president of marketing and got demoted to a burger flipper, that's not what you signed up for. So the company's put you in a situation where you have good reason to resign. Or let's say they called you a fair market salary of $100,000 and they changed it on you halfway through. Well, that's a good reason to resign. It's not what you signed up for. Or let's say the company changed their compensation plan or their bonus plan or your job, or even they pivoted the company, for instance. If it's not what you signed up for, you have a good reason to resign. And lastly, is you could resign for no good reason. It may be a good reason for you, but not for the company. You may not be able to afford to work for free anymore. You may not like the company anymore and want to quit. You may get a better job somewhere else. Resigning for your own reasons is called resignation for no good reason. In the first 2 scenarios, in 2 of these scenarios, the employee has made decisions that negatively impact the future of the company. If you get fired for good reason or you quit for no good reason, you're putting the company in jeopardy. So you lose your slices for non-cash contributions. So the time you invested would not earn you any slices because you're not staying through the end. And you would lose your multiplier for cash or tangible property, which means that if you put $1,000 of cash in, you would simply pay the person back. So leaving under these circumstances is painful, as it should be, because you're leaving the company in the lurch, and people need to be committed in order to get the payout. So we want to provide a disincentive for people to quit the job or not perform on the job. If you don't perform or you quit, you don't deserve a piece of the pie, and the company can get it back. On the flip side of the coin, if you're resigned for good reason or you're fired for no good reason, you get to keep your slices in the pie. If the company wants to buy them back, they buy it back at $1 per slice or whatever your unit of currency is. So if I put 100 hours worth of my time at $50 an hour, that's $5,000 worth of time. The company has to pay me $10,000 to get rid of me, which is a nice return on my money. So it's a penalty for the company for making choices that negatively impact the future of the individual. So what's going on here is we have a built-in retention program for employees and a built-in severance program for the company. A built-in retention for the company and a built-in severance for the employee. This providing the right level of protection for each person in the organization. So getting another question here. How to equalize pies between a founder who has invested 3,000 hours of development time, finalized product, formed a company, recruited initial employees, performed all marketing, new hires can only catch up on a percentage basis over a term of years. Also, they expect a certain percentage as a standard, or example, free VP gets 10%. So it's going to be difficult for someone to catch up with a founder who has 3,000 hours, and that founder has made a huge bet already. New people coming in will earn on top of that person, but after a year or so, they might They may never catch up unless that founder pulls back on their time. There's no such thing as a standard. Standards are red herrings. They always change. Whatever you give someone as a standard will automatically come in and bite you. If you say a VP gets 10%, what you're saying is, we think this VP is going to provide 10% of the value in the company. There's no way you could ever predict that. So the slicing pie model will always give you what you predict. Another question, is it okay to give non-active founders equity? If so, how much is reasonable? Is this seen as goodwill to investors or a red flag for them? For example, a few people participate in initial idea creation but do not want to be part of the business, like a non-active, non-voting member. Anybody who contributes to your company, no matter how small, you can always give slices to. You might have someone who works with you for a few hours here and there and give them a few slices. Investors will see value in having people properly aligned with the company. If they're not aligned with the company, you're just taking advantage of people. If you have an absentee owner or someone who's not participating in the company and owns slices, that's a bad thing if the absentee owner is not properly aligned with your interests. So if they're pissed off at you, for instance. But if they were a helpful friend along the way, then by all means, you can give them slices. There's no limit to how many slices you can divide in the pie, and their share for their few hours of work will always be properly reflected in the outcome of the company. Another question is, how does the model account for contributions that did not produce anything substantive? Can't pronounce that word, I'm sorry. Team member contributed to a relationship that offered little more than a few interesting conversations. Well, in that case, there would be no commission payout because it didn't convert into a sale. So there would be no payout. If someone's contributing to your company, imagine yourself on the job at a real company. You're hired on a salary, you get paid your salary weekly or monthly or however you get paid. If your work is unproductive, you would get fired for cause, and this company would get your equity back. If you're productive, you would get a raise. So the model never accounts for things that aren't. If you're working hard, you might work on a deal for months and it doesn't work out. You might get rewarded for the time you put in, but you wouldn't get your commission if you're a commission salesperson. But people do all kinds of things in companies that aren't totally productive, but people still get paid. If someone's habitually non-productive, you would fire them. If they're habitually productive, they would get what they deserve. What's appropriate to offer a non-founding CEO hired later? The non-founding CEO, you hire that person, you determine their fair market salary, and they would earn slices per hour going forward. You could give them a sign-on bonus if you wanted to, but I would just say, here's the number of slices in the pie going forward. You can add someone anytime you want. You can always add and subtract people as needed. It's a very fluid model, so it's easy to add and subtract people. Yes, there'll be a replay played here. This person says, I can see there would be a point that I would not want to work for a startup unless they're using the slicing pie model, not to take the risk and waste my time being properly valued. Yes, absolutely, Glenn. Thanks for the question. I personally would not work for a startup company that did not use slicing pie. If someone does not want to use the slicing pie model, there's two things that are going on. The first one is they haven't fully understand the impact of what I'm talking about or how the model works. The second thing is that they want to benefit at someone else's expense. They want to lock in their too much equity and basically ride on the backs of others. People who don't want to use the slicing pie model want to be free riders or don't understand that it is a binary equation. They either don't understand it or they want to be a free rider. That's a pretty bold statement, but once you get your head around how slicing pie works, as Glenn has pointed out, any company not using this is bound to have free riders. And those who push back heavily on it are the people who want to be free riders or they don't understand the model. So please take the time to understand the model, and it will become, I believe, the universal standard for every startup company in the world. This is the friction point that every startup experiences. This is the only way to get a perfectly fair split. So how does the model fit into the bylaws, cap table, and official documents? So there's a number of legal agreements all over the world. There's attorneys all over the world that can do this for you. So if you want to know an attorney in your area, send me an email and I'll help you find one. But in Europe and England and in the Netherlands and in Australia and Africa, and of course the United States, there's attorneys who have put this in place. In some cases, slicing pie is a vesting program. So time-based vesting is a typical program, and time-based vesting is a way to protect someone from bad equity splits, because all of the equity splits are bad, so vesting helps protect it. You don't need that in slicing pie. It becomes your vesting tool. Yes, there'll be a record replay for the call, and I'll set up another webinar. This technology didn't work very well. I'll set up another one too. Question, how can we retrofit what you've already invested? There's a retrofit guide online. I can send you an email on how to find it. The retrofit guide will help you account for what's already gone into the pie, and what's come out of the pie, and will tell you what the starting slices is. So Caroline says, the place I suggested in Canada said they've never done it and not sure how they can. There is a couple of attorneys that I referred to them. They're not very communicative to me, so I'm not quite sure what their success rate has been in terms of implementation. I'm actively looking for an attorney in Canada that can do this. Ryan wants to have a results-based company, not so much based on the hours someone works, but on the results. Can the model still be used for that? Yes, I would encourage you to set goals and milestones for your employees and provide bonus payments for them, the same way you would do in a real company. I would not give them equity, slices for their time, though. If someone can get a job and get paid for their time, by not paying them, you wouldn't work for a real company and they would say, okay, every week, hey, Mike, we're going to look back at what you did last week and pay you based on the value of that. It would be too stressful to work there. It wouldn't be fair. There's no reason you can't use SlicingPie to give a bonus payment or a reward, but I would not substitute the salaries component for a bonus program alone. ×2 for Canada. I'm not quite sure what that means, Hakeem. Jonathan says, when is the time to slice the pie? For 6 months, 1 year, 2 years, a specific time frame? You use the slicing pie model until the company breaks even. And here, let me show you how that works. So let's say we're going to show them. I'm going to pause in a second for questions and take you through this Ren's recovery program. So here we are. We've converted to slices. We're going to fire this junior developer. We give her a warning, given her a second warning. Now we're going to fire her. And all we do is subtract her. She had non-cash contributions in the pie. We're going to take her stuff out of the pie and recalculate her in shares. So here's number 2, 3, and 4. And now the pie is readjusted to accommodate the fact this person has left the company. They're not necessarily better off, even though they have more equity each, because they've lost this person and they had to hire a new developer. So they go find some new person. That person will start earning slices in the pie. So the pie is properly adjusted to reflect the fact the person has departed. Now, eventually you want to freeze the pie. This will address your question. Freezing the pie means it no longer accumulates slices and no longer used. There are 2 times you would do this. The first time is when you generate enough revenue to pay people. This is break even. Or you have a Series A investment event that covers your immediate costs. So here's how this works. So let's say I'm paying someone a $100,000 fair market salary, but in slices, and I pay them $0. That means they're earning 100 slices per hour. That means their whole salary is at risk. As the company starts generating revenues, they can use that money to pay salaries. So let's pay this person $25,000 a year. Now he's taking less risk, and so our grunt hourly resource rate is down to 75 slices per hour. As the company progresses and gets more money, we can start paying this person more money. That reduces the number of slices per hour they get. We pay them more, again, reduces the number of slices per hour they get. When we're paying their entire salary, they continue working and they accumulate 0 slices per hour. When everyone's getting paid, there are no more slices accumulating. The pie will naturally freeze. So here it is naturally frozen, and then the profits come in or the proceeds of the sale come in. Each person gets their fair share based on their split of the pie. This is the bet paying off. Back to that blackjack example, when the bet pays off, the person who put $3 down gets 75%. The person who put $1 down gets 25%. They're all going to win, but they're winning in proportion to what they bet. The other time you freeze the pie is when you raise money. So in this example, let's say we negotiated a pre-money valuation of $900,000. We raised $1 million. This means this company is worth $1.9 million, which sells 53% of the company. We use that money to pay our salaries and our expenses and our marketing and our growth. And now when the profit comes out, we split it with our Series A investor. So the people that are participating in the original pie still have their fair share of the investment. And the Series A person comes in as well. So what I've shown you is a perfectly fair model. It rewards actual contributions that are made. It provides ongoing motivation, so I can make my own choices about how I run my life. If I want to make more commitment, I'll earn more pie. If I want to earn less commitment, I'll earn less pie. I showed you how to add and subtract someone without any problem. It's flexible in the face of rapid change. I did not have to stop and call my attorney and change my agreement every time someone joined the company. And at no time does anyone have to think they're getting more or less of their fair share. So we've gotten rid of the gators. There are lots of resources for you. I'll go back to your questions in a minute. Of course, Slicing Pie is the book out there. It's on Amazon. You're welcome to pick up a copy of Slicing Pie or get a copy from me. The book has been translated into a number of languages all over the world. If you want in your native language, let me know. There's more languages in the works. I have a brand spanking new book coming out soon. It's called the Slicing Pie Handbook. And it's a Slicing Pie book rewritten. It's a standalone book, but it's used a little clearer language. It is based on the popular Slicing Pie. Rewrote that book from scratch. Keep in touch with me if you want to get your hands on a copy of that. Slicing Pie has software that goes with it. So if you want to create your own pie on our software, you can use it to track everyone's contributions. People log in and track their time and expenses and contributions over time, and it divides the pie in real time for you. There's all kinds of resources online. I think I put a link on the webinar. There's attorneys, there's spreadsheets, of course, my blog, and you can even set up a call with me. Go to my About Mike page and click right here, and you can set up a call with me personally to walk through your individual problem. So lots of resources. Let me get back to your questions now. Okay, so Caroline's saying there's people in Canada. I'm actually looking for lawyers now. Please keep posted. I'm trying to find a Canadian lawyer. The lawyers that I found just aren't very responsive. They were really gung-ho about Slicing Pie, but some countries I'm really keyed into. Some countries a little harder. So Fabio asked for a doc with all the questions, your answers, and send it to us. He needs to leave. Fabio, send me an email, and I'll get you some answers to your questions. And of course, my blog and videos and books have all the answers as well. Dan says, we crowdfunded after establishing dynamic equity model after Kickstarter brought in $128,000. Nice job. Decided to keep it another 6 months of dynamic venture. This means we've been Slicing Pie. Sorry, this keeps bouncing around on me. Someone's asking for the retrofit guide. Send me an email. It's on the blog. Just search retrofit guide for the retrofit guide. One point of resistance is time commitment versus take advantage of being fair. My initial reaction to your book was selling the time commitment to the team. We all agree that it requires a bit of selling. Time commitment can adopt to adopt this plan. It's really it's not a very complicated thing to put in place. You just got to keep track of what you're doing. You can keep track of time in whatever granularity you want to. You can keep it on a daily basis or an hourly basis or a monthly basis if you want, whatever granularity you're comfortable with. Hourly helps you account for the fact that people are different. This is a new model, and people do need some learning, but there's a short book that you can get online called Get Them Gators, or I'll send you a free sample of the Slicing Pie Handbook, which is a chapter about convincing your partners. So I'd be happy to help you work on that problem. Other questions here. Buyback question. Someone's asking about a buyback. I'm sorry, every time someone puts a question, I jumps out of here. Someone's asking about a buyback clause. Those for the absentee owner. The slices will determine your buyback clause. It depends on the nature of their departure. If someone leaves, if the company causes their dismissal, if they're leaving for good reason or they're fired for no good reason, it's the employee's option to sell back or not. If the person got fired or the company or they quit the company, then the company can force a buyback. So the buyback depends on the nature of the departure. If you think about that, you can't hire someone, have them take risk for you, and then force them to sell out at a small price. If you don't want the person to be an absentee owner, you shouldn't fire them. That's explained in the book more. So why to do 2x salary and 4x for cash versus 1x for salary and 2x for cash? Seems simpler. When I first invented this model, I used 1x for salary. What happens is you don't create any consequences on the back end. The multipliers not only normalize the just different types of contributions, but they create consequences on the back end for someone departing. So if I used 1x for cash, that means I could come work for a year, take all that risk, and then not leave with anything, not have any premium for my risk. So if the company says, I'll just pay you when I get around to it, you're basically deferring someone's salary, and they're taking a lot of risk for doing that. The 2x says, I'm deferring my salary, but I'm getting paid a 2x premium. So the company fires you for no reason, it's gonna hurt. You can't have someone come on and work for free and then not get a premium if they get fired. So the company can take advantage of people very easily. So the 2x creates a consequence for the company to push that employee out. And this happens all the time. There's all kinds of unscrupulous managers out there who will fire employees and take advantage of them, take their equity back. I worked for a company once. This was the habit of the founder of the company, was just to fire people and get their equity back for free. So by using 2x, it puts some teeth into that decision so that the company won't make flip decisions on letting people get fired for no reason. So you got to give them some teeth. Let's see other questions here. Fabio says, thanks, you're welcome. Glenn's question is very important. How does my model work when raising funds from angel VC firms, etc., and valuing the equity slice of the pie they receive at any given point, 4x time of use versus cash at the time of investment? When investors buy into having their equity reduced over time, more than money. So the slices in the pie have nothing at all to do with valuation. They have nothing to do with value. All they do is help you keep track of what's been bet. Your valuation is based on your ability to negotiate a value with your investors. If it's an angel investor, a small investment that does not cover your immediate cash needs, I always encourage people to use a convertible note. If you're doing a large price round with a VC, then you'll want to negotiate your price, your valuation based on the merits of the company, not on the pie. The pie's got nothing to do with that. The nice thing about the slicing pie model when it comes to investors is when they do due diligence, you can show them your logs of all the time that's been spent, all the money that's been invested, and know who's done what, and all kinds of commitment. They'll know more about your company than the other company. So for due diligence, it's a wonderful tool. They can see what the use of cash is and all those kinds of things. But VCs, which typically cover all the costs, so the pie would terminate at the time you got a venture capital investment. I hope that answers your question, Glenn. In terms of best practices, should this leader of the status of the pie contribute ownership on a regular basis and transparent to all the grunts? I always encourage transparency. The slicing pie software allows people to log in, and there's two different settings. One is called an executive setting, which allow everyone to look at all the details of each pie slice. The employee setting just allows them to see their own. But the more transparent you can be in the beginning, the better. If you have a number of sort of arm's length participants, you may not want to share details, but transparency is always good. What I've heard is that the more transparency, the better. Portuguese, there's a Portuguese edition for sure online. It's called Dividir o Bolo. It's on slicingpie.com. Look under international editions. There's a Portuguese version of the book. How often do you keep track with your team? The Pie Slicer tool allows them to log in and just keep track on a regular basis. Sort of best practices I've seen is every Friday people turn in their time cards. I've seen companies have agreements that says if you don't turn your time cards in on Friday, they don't count. So that's a good way to get people to turn in their time on time. Lots of good questions. I appreciate it. Let's see. What do I tell newcomers if I have a 90% of the slices? They feel like they'll never catch up. It depends on how many slices there are. In the beginning, after your first month of work, you'll have 100% of the slices. It depends on how long you've been in the company. If there's 2 million slices in the pie and you're adding newcomers and not paying them, that means you spend a lot of time and a lot of resources developing a company that doesn't have any revenue. You got to rethink whether or not the person wants to join the company in the first place. But if there's too many slices in the pie, you got to rethink, what have I spent all that time on if I can't generate revenue? So, a big pie is not an attractive proposition for new employees because it's a company that hasn't been able to pay employees. So you got to convince someone that you're about to turn a corner. But usually founders that have a lot of slices accumulated will have to hire a team, and the team will catch up over time. But if the founder put in $1 million cash, then they deserve the majority of the equity. That's just how it is. Anything that above that is just a gift. So slicing pie, no matter how many slices in the pie, will always tell you what you deserve. If I worked 10 years, blood, sweat, and tears, and you came in for a month, you don't deserve very much equity in the company. Ryan, yes, the book is available in Dutch. Look at Slicing Pie International versions. It's called Tart Verdenland, I think it's called. So yes, it's available in Dutch, and there are Dutch contracts, and I have attorneys in the Netherlands that can help you out. David asks, if the Series A investment gets 53% of what's left for later rounds of investments, you would simply set a new valuation for your Series B investment, and everyone would dilute appropriately, including that Series A investor. So just because you gave 53% away doesn't mean that you can't issue more shares. Someone's asking about the spreadsheet. The spreadsheet is a free resource you can download. I like the pieslicer not only because I make money on it, but it's easier for everyone to track. It's a little more robust than the spreadsheet, but it's available for free download. And be happy to get that to you. Swedish lawyers, yes, they're Swedish lawyers. There's an EU lawyer that can put you in touch with someone in Sweden. So I'd be happy to send me an email, look at the lawyers. Send me an email, Johan, and I'll get you in touch with the Swedish resource. The spreadsheet resource, look on slicingpie.com on the resources page, and you'll see a link to the Slicing Pie resources. So it's this page. You can see the calculator on here. There's a resource page under the resources tab. Caroline, it seems as though the more one of my people work, the less percent she gets because she's doing 50% free, 50% paid. Since I pay her, I guess that's the 4x, so she gets 2 times. Yes, so if you're paying her cash out of your pocket, you get 4x, she gets 2x. That aligns your incentives. The less money she takes, the slower you earn slices and the more she earns slices. The last place you want to put money in a startup is in the pockets of the founders, in the pockets of employees. Employees can put time in for free. So if money's being spent on them, you want to wait till revenues come in before employees start getting paid. But if someone's paying out of their pocket, they're taking much more risk than the person who's not. So your cash, so if I take out $100 in my pocket and pay you $100 an hour, you're earning no slices and I'm earning 200 slices. If I pay you $50 an hour, you're earning 100 slices and I'm earning 100 slices. I'm earning 200 slices too. So if I pay you 100 slices per hour, $100 per hour out of my pocket, I earn 400 slices per hour and you're earning nothing. If you take $50 instead of, then you'll earn 100 slices and I'll earn 200. If you take nothing, then I'll earn no slices and you'll earn 200 slices. So you want to encourage that 4x multiplier discourages people from consuming cash. You only spend cash when you really need to, which is the right thing to do. What do you suggest a standard profile for a grunt fund leader? A grunt fund leader is simply someone who administers the fund and keeps track of everything. They're not a special person beyond that. Usually it's the founder of the company, but it's just someone you can trust that can manage the profile. Is there a LinkedIn group of users? There's a LinkedIn group that I never put a lot of time into it, unfortunately. But there's a LinkedIn group that I post to once in a while, but there's not a user group so much. But I'd love to set one up if anyone has any ideas how I can get that done. Lots of good questions there. I'll go back through and see what I can find. I like the tracking tool, but I want a web app. Yes, we're doing a web version of the software that's in the works right now. Thanks for the question. Glenn Robinson asked if I would like to speak to I'd love to come down to Austin. Give me an email. I'd love to find a way to do that. I look for sponsors for my trip, but I was in South by Southwest last year, and that was a great talk and a huge turnout. Austin's a great community. I'd love to get down there and do some work. So Glenn, please reach out to me, and I'd be happy to talk to you about getting down to Austin. Is it recommended to have legal agreement to get a new grunt on board or just trust? You can use trust. The book is detailed enough that it outlines all the rules, but what you want to be careful about without legal agreements is the way you treat your allocation of shares in the beginning to avoid taxes. So sometimes in the slicing pie model, if you're in a C corp, for instance, you might issue restricted shares even to new people, and the slicing pie model would determine which of those shares actually vest at the end. The other way to do it is to issue restricted shares and then do a buyback at the end. And there's some tricks in there to help reduce the tax burden. The key is to make sure that most of your earnings are through capital gains and not through income. And the way you file 83B elections and things like that will be important. So having a lawyer and a tax advisor involved in the beginning is an important thing to do. I've seen companies, build a lot of value just on trust, which is great. But when they start issuing shares, there were some tax burdens there they weren't expecting. So it can be a burden, especially in LLCs, for instance, where you might allocate earnings to one person and their basis might change. So I don't pitch myself as a tax attorney. I do know some of the rules, but definitely get in touch with someone who can help you there. If an investor is offering a safe note, including the possibility of getting 4 times the purchase amount of liquidity event, how we should convince this venture capital to use the slicing pie model. So slicing pie is for sort of your immediate team. And if you have an angel investment, just treat it as an angel investment. They wouldn't get a safe note and slice the pie. They would get it instead of the slicing pie. So your slicing pie model will determine your shares for your founder teams and your partners and your participating employees. But if you're going out to raise a couple $100,000 from an angel investor that's going to be arm's length, I wouldn't put them in the slicing pie model. Now, if they insisted, then you'll have to consider that as what I call a well investment. A well investment is when they put money into your company and it's only converted as it's spent, and the software has a tool in there to convert the well. So I put my money in the safe. I put $50,000 in the savings account from an angel investor. They get no equity at all. When I withdraw that money to spend on expenses, it would convert at 4x into slices, and that investor will participate on an ongoing basis. But if you can just get a safe note, that's a more efficient way to do it. Safe notes and convertible notes represent the fair market for angel investments, so they're perfectly legitimate. Any suggestions on how to best pitch the slicing pie model to prospective grunts? The gambling example I use is a very good one. And you can also download a free sample of the Slicing Pie Handbook. And that has a chapter, and chapter 11 of that book is a story about how slicing pie works, and it's a quick story about how it works to convince prospects. So send me an email, David, and I'll get you a copy of that. It says, TMB says, why do I suggest convertible notes? Convertible notes and safe notes are good ways to use to handle angel investment money rather than doing a valued round. When you put a valuation on a company, you run into a number of problems, in my opinion. The first one is you run the risk for potential fraud. Without a documented private placement memorandum, which is a very expensive document, and properly disclosing all the ands, ifs, or buts about your company, putting a price on your equity is a problematic thing. And I steer people away from that. Not only can it create tax problems for people receiving equity, it's usually not a very accurate round. So when you sell equity or common stock, or whatever you sell in your company at early stages, you're doing yourself a disservice. You're borderline unethical. You're causing problems with you. You're making up a valuation that may not be causing, not in fact. Slicing pie will help you avoid that valuation. A convertible note or a safe note will help you avoid the valuation. Only do a priced round when you raise enough money to cover all your expenses in the foreseeable future, which is a Series A investment. Otherwise, try to avoid doing a priced round. So I always say, I don't tell people to do it. As convertible notes, avoid that pricing. Trevor asked this, yes, then you'll get an email follow-up with a link to the replay of this webinar. And I'll schedule more webinars in the future with a little better technology next time. I apologize for that. So we're going to wrap it up here. It's been an hour. I don't want to keep anybody any longer. Thank you very much for your questions. Wonderful questions. And please keep in touch with me. And I'll looks at some questions are posted below too. I'll stay on for folks actually to answer these other questions. I was just answering questions from the chat window. But this is the formal end of this thing, but I'll keep going just to answer these questions. Webinar is recorded, so I can refer back to it. Yes, got that question answered. If the partner, the participation of the partner is equal in his dedication, right? He contributes less than his percentage is smaller. Let's see. If he contributes less, his percentage is smaller. But let's say after 1 year, here's number 3. I think I answered that question. As the person's contribution ebbs and flows, they'll earn fewer and more, less equity, the slices, and that will reflect their equity split. If 2 partners work their butts off head to head for 6 months, they're still going to have, they might have accumulated thousands of slices each, but they'll still have 50-50. If one partner pulls back for a few months, they'll lose ground. If the next partner pulls back at the same time, so it's just their slices can be divided by all the slices. My potential partner wasn't available to participate today. Is it being recorded? Yes. And there's all kinds of recorded videos online, so send me an email. I'll make sure I get that to you. It's mike@slicingpie.com. Someone, Fabio says, I don't know if I can explain my doubt. Not knowing if you can, your doubt is because it sounds too good to be true, and it sounds like nothing could be perfect. So the way to get across over your doubt is to read the books and spend some time going through the model and seeing how it works. I promise you that when you get your head around how this totally works, you'll see that it's absolutely fair. And people who are immersed in this model don't see how the other world can be fair, don't see how a traditional split can be fair. If you and I go in 50-50, we think we have a 50-50 deal. But something's going to change. Before we get to Series A or break even, something's going to change. Absolutely. There's no way whatever we agreed to in the beginning is not going to change. And when it does change, it's going to be based on our ability to negotiate or fight or argue about things. Slicing Pie accommodates that change by making sure everything stays fair. So your doubt is based on you're still getting your head around the model, and that's fine. Let me know, and I'll get you anything you need to get yourself comfortable with the model. When is the time to slice the pie? 6 months, 1 year after a specific milestone is you. I think I answered this one. It's when you reach break even and no more slices are being accumulated, it will naturally freeze. And incidentally, some of you who read my book, Slicing Pie, are familiar with the term theoretical value. A slice is the same thing as a theoretical value of dollar. So I now use the term slices instead of theoretical dollars. US and EU legal systems are more or less different. EU uses a civil law system, which is has a little less flexibility. US and England are common law programs where they have rely more on the courts. There's an attorney in Switzerland, in Zurich, who is developing contracts for the EU system. I'd be happy to put you in touch with them. So send me an email. I'll put you in touch with Jana. She's most countries in the EU are going to be covered by her. There's tax issues from country to country, but that's something that we've addressed. So please let me know, and I'll put you in touch with Jana. What aspect should I consider to set the time the startup started to facilitate the calculation of intellectual property? If you started developing, you got to consider whether the IP was developed, quote unquote, on the job or off the job. On the job would indicate that the day you started developing your idea is basically a time calculation. That means your company hired you for a salary and didn't paid you in slices instead while you developed that IP, in which case the IP is owned by the company. If you developed the IP before the company started, then you would license the company at inception to your company and pay yourself a royalty in slices and even an advance in slices. So you had to consider, was the time you started developing the IP part of your company, or was it developed before the company? So for instance, if I started a company based on Slicing Pie right now, I wouldn't count all the hours I've spent developing Slicing Pie over the past 6 years. In the pie, I would just say, okay, I've developed this IP. I'm going to license it to the new company in exchange for a royalty. Best practices on pitching Slicing Pie to prospective grunts. Download the Get Them Gators or the free sample of the Slicing Pie handbook, and it's a chapter on convincing your partners. I'd be happy to give that to you. Do you mention in the book to use a last salary as a base salary for GHR in case in some cases, doesn't seem fair to me. The previous salary cannot correspond to the skills of the current position in the startup. What do you suggest? So what I suggest there is negotiate the salary like you would negotiate any salary for any company. So you're considering hiring someone, their past performance and their past salary will impact their own decision-making. So if someone is making $200,000 a year as an attorney and you're trying to hire them as a paralegal, they probably won't take that job if you can't offer them a good salary. So their past salary is an indication of what they're giving up, but it may not be reflective of what you need in your job. So for instance, if you're hiring a $300,000 a year CEO, that might be too expensive for your startup. You might want to pay $100,000. So you want to make sure that your salary is commensurate with the requirements of the job. Startups don't have budgets. They don't have employees. They don't have revenue. They don't have a lot of responsibility. So people who don't have a lot of responsibility don't get high salaries. If you're coming from a Fortune 500 company with a $10 million budget or $1 billion budget, then you get paid a lot more. It's just the nature of the game. So previous salary does not always indicate your startup salary. You just got to make sure you negotiate it like you would anything. Negotiating a salary is much easier than negotiating an equity split. And you want to negotiate a salary that's going to be paid when you can afford to pay it. So when you raise money, you'll be paying salaries, and that's what you'll be paying. If you went to investors and said, hey, we're all planning on paying ourselves after we raise Series A, and by the way, I'm worth $10 million a year, they're going to laugh you out of the room. If you say I'm worth $100,000 a year, they might say, that's logical. That seems like a logical salary. So place it based on what a typical salary negotiation would be. So I answered this one already. Fair market salary for a person's time and effort changes over time. How does the slicing pie model take that into account? So you would give someone, if they're a great performer, you would give them a raise, and the new raise would apply to the new slices earned over time. So you just treat it like, so always think about it. If this person was getting paid, how would I compensate them? If I give them raises and then I can't pay them, I give them slices instead. Thanks, Mike. Do you know if this sort of dynamic split arrangement is legal in India? It's definitely legal. It's always legal to be fair. So always make sure that you have the proper documentation. And I'm on the lookout for attorneys in India. But the book is being translated into several languages in India right now, too. And I know there are people in India who use it. I'll be happy to send you legal agreements that you can use. But there's no legal issue. It's just a matter of documenting and making sure you account for taxes. Those are the big issues you want to face. So I'll go back to a few more questions in the chat box. Caroline, see the royalty payment being something that investors wouldn't like. Am I correct? Investors may not like a perpetual royalty payment. That's true. So it may behoove you to put a buyout on the royalty so investors can choose to buy that out. So you might say that it will pay you up to $1 million in royalty payments. But royalty payment, if the technology is hot, they may not mind paying a royalty. So there's certain businesses where that's okay. Like if I was buying a publishing company, I would expect to be paying royalties to all the authors and inventors and things like that. So, when the investors put whatever terms they want on the table, if they work for your company, they work for your company. If they don't work for your company, they don't work for your company. If the inventor is the founder, you can negotiate a buyout in exchange for that investment if you wanted to. So royalty can become a problem, but you got to be prepared to negotiate it. That looks about all the questions. Germany. So send me an email follow-up. I'd be happy to help you guys out. Thanks for participating today. And I think I've answered everyone's questions, and maybe there's no one on there. It looks like there's some people left. But thanks you very much for coming. And please take the time to use Slicing Pie in your company. I promise you'll get exactly what you deserve, no more and no less.